An extra $1,000 every single month, landing in your account while you're sleeping, working, or finally taking that vacation you've been putting off. Most people hear that and think, sure, if I had $1 million sitting around. But here's what they don't tell you. The math is way simpler than you think. And if you've already done the hard part of building up some savings, you're closer than you realize. I'm about to walk you through the exact blueprint I'd follow to build a portfolio that pays me $1,000 every month. No lottery tickets, no crypto gambling, just proven, boring stuff that actually works. Before we dive in, quick heads up. This video is for educational purposes only. I'm not a financial advisor, and nothing I say here is personalized financial advice. You should always do your own research and talk to a qualified professional before making any investment decisions. Data I'm sharing is current as of December 2025. Alright, let's get into it. Let's talk about the situation you might be in right now. You've done everything right. You've been disciplined. You've cut back on stuff you didn't need. You've built up what most people would call a respectable nest egg. But now it's just sitting there. If it's in a savings account, you're probably earning what? 0.5%? Maybe 1% if you shopped around? Meanwhile, inflation is taking a bigger bite out of its value every single year. Every investing article screams, put your money to work, but nobody actually explains how to do that without it feeling like you're walking into a casino. One wrong move, and poof, years of hard work gone. This is what I call the saver's dilemma. You have the money, but you don't have a clear, step-by-step plan to turn it into a reliable monthly income. You're not trying to gamble. You want to build something that pays you like clockwork. That's exactly what we're going to design. Here's the solution, and it's probably the most straightforward strategy in investing: dividend stocks. Strip away all the fancy jargon for a second. When you buy a dividend stock, you're buying a tiny slice of a real company. And because you're now a part owner, that company shares a portion of its profits with you. That's your dividend. Think of it like owning a piece of an apple orchard. You're not doing any of the actual work. You're not planting trees or picking apples. But every time they sell the harvest, they cut you a check for your share of the profits. That's it. That's all a dividend is. These payments typically show up every 3 months, straight into your brokerage account. You can pull that cash out and spend it, or, and this is where it gets interesting, you can use it to buy more shares. More shares mean bigger dividends next quarter, and those bigger dividends can buy even more shares. Over time, this creates what I call the dividend snowball. It starts small, but year after year, it picks up speed. Your money earns dividends. Then your dividends start earning dividends of their own. You're not getting rich overnight, but you're building a machine that pays you for decades. Alright, let's stop dancing around the big question. How much money do I really need to generate $1,000 a month or $12,000 a year in dividends? The formula is dead simple. Annual income goal divided by the dividend yield gives you the total investment needed. The dividend yield is just the percentage a stock or fund pays you each year based on its current price. Let's run the numbers with a few realistic scenarios for that $12,000 annual goal. At a 3% average yield, you'd need $400,000 invested. At 4%, that drops to $300,000. At 5%, you'd need $240,000. Now, I know seeing $300,000 might feel like a gut punch, but I want you to reframe that number. Don't see it as a wall blocking your path. See it as your destination. This is your roadmap. And here's the critical warning. You're going to see stocks and funds out there advertising crazy yields, 9%, 12%, even 15% or higher. I need you to hear me on this. Chasing those high yields is one of the fastest ways to lose money. Here's what most people miss. When a yield looks too good to be true, it usually means the stock price has crashed because the company is struggling. And a dividend cut is probably right around the corner. A rock-solid 4% yield from a quality company will beat a risky 10% from a failing one every single time. Over the long haul, boring wins. You know the goal. You know the numbers. Now let's actually build this thing. Here are the 4 steps. Step 1. Choose your tools. ETFs versus individual stocks. First decision. What are you actually going to invest in? You've got 2 main paths: ETFs or individual stocks. For most people, especially if you're just starting out, I strongly recommend Dividend ETFs. Think of an ETF as a pre-built basket of stocks. Instead of you spending hours researching individual companies, the fund does that work for you. You get instant diversification in one purchase. One of the workhorses in this space is the Schwab US Dividend Equity ETF, ticker symbol SCHD. As of December 2025, it holds about 100 high-quality US companies and yields around 3.8%. Another great option is the Vanguard S&P 500 ETF, ticker VOO. This one gives you exposure to the 500 largest US companies. Its yield is lower, about 1.1% as of December 2025, but it's built for strong long-term growth. Starting with a core ETF like SCHD is the simplest, most effective way to get moving. Your second option is picking individual stocks yourself. This gives you more control, but it requires more homework. If you go this route, here's the golden rule. Diversification is non-negotiable. Aim to own 20 to 30 different companies spread across at least 10 different sectors: healthcare, tech, consumer goods, energy, financials, and so on. Never put more than 5% of your portfolio into any single company. This is your insurance policy. If one business hits a rough patch, your whole portfolio doesn't go down with it. Step 2. Automate your growth. Turn on DRIP. Step 2 is the secret weapon that supercharges this whole strategy. DRIP, Dividend Reinvestment Plan. This is just a simple setting in your brokerage account. You flip it on, and every time you receive a dividend payment, your broker automatically uses that cash to buy more shares of that same stock or fund, even fractional shares. Here's why this matters. Let's say you start with $10,000 invested. That might earn you $400 in dividends the first year. With DRIP turned on, that $400 automatically buys you more shares. Now you've got $10,400 working for you. Next year, you earn dividends on that larger amount. The year after, even more. It feels slow at first, I'm not gonna lie. But after 10, 15, 20 years, the growth becomes an avalanche. Turning on DRIP is the closest thing you'll find to putting your wealth building on autopilot. Step 3. Fuel the fire. Consistent monthly contributions. Think of your initial investment as the launch pad, but the real rocket fuel? That's your monthly contributions. You're not going to wake up tomorrow with a $300,000 portfolio. The key is committing to invest a set amount every single month, rain or shine, market up or market down. Whether it's $200, $500, or $1,000 a month, this strategy is called dollar cost averaging. You buy more shares when prices are low and fewer when they're high. Over time, it smooths out your average cost and removes all the stress of trying to time the market. An extra $500 a month is $6,000 a year, before any growth or dividends. This habit is just as important as your starting amount. If you can, set up an automatic transfer from your checking account. Make it so you don't even have to think about it. Step 4. Avoid the traps. Don't blow it. Building wealth isn't just about the smart moves you make. It's also about the dumb moves you avoid. Here are the 2 biggest traps. Trap number 1. Chasing sky-high yields. We already covered this, but it's worth repeating. If you see a stock with a 10% or 12% dividend yield, your first reaction should not be excitement, it should be suspicion. 9 times out of 10, that high yield is a warning sign. The stock price has tanked, the company is struggling, and a dividend cut is probably coming. A safe 4% from a strong business beats a dangerous 10% every time. Trap number 2. Not diversifying properly. Owning 5 different tech stocks is not diversification. That's just putting all your eggs in the tech basket. Real diversification means spreading your money across different industries. When tech is down, maybe energy or healthcare is up. By owning a slice of everything, you create a much more stable, all-weather income stream. This is yet another reason why starting with a broad ETF makes so much sense. Alright, theory is great, but what does this look like in real life? Let me show you a simple, hypothetical portfolio that follows this entire blueprint. This is a 3-fund strategy designed for simplicity, income, and long-term growth. 60% in SCHD, your foundation. Quality dividend-growing companies with a solid 3.8% yield as of December 2025. 30% in VOO, your growth engine. The entire S&P 500. Lower yield at about 1.1%, but built for long-term price appreciation. 10% in VNQ, Vanguard Real Estate ETF. This gives you exposure to REITs, which are known for higher yields, around 3.9% as of December 2025, and adds diversification into real estate. 3 funds, that's it. Incredibly diversified, cheap to own, and ridiculously easy to manage. This blended approach gives you a healthy dividend yield while still positioning you for long-term growth. It's the perfect example of how to execute this plan without being a stock-picking genius. Getting to $1,000 a month in dividends isn't some fantasy reserved for the ultra-wealthy. It's a real, achievable goal that comes down to having a clear plan, staying disciplined, and being patient. The numbers we talked about today might seem big, but they're not impossible. By starting with what you have right now, using simple tools like dividend ETFs, turning on DRIP to automate your growth, adding money consistently every month, and avoiding the common traps, you're building a system. A system that works for you around the clock. Slowly at first, but then with unstoppable momentum. You've probably heard the saying, the best time to plant a tree was 20 years ago, the second best time is today. Your journey to $1,000 a month in passive income starts right now. Remember, this information is for educational purposes only and should not be considered financial advice. Thanks for watching, and I'll see you in the next video.